Hi, everyone. Thanks so much for joining. It has really been a mixed week for volatility. At the end of Friday, we saw that massive sell-off on the back of tariff risks. On Monday, we saw the recovery. We didn't recover all of the losses, however. And then on Tuesday, it looks like we're heading lower again as the trade talk rhetoric ramps up from both the US and China. Now, the risk is that this will continue for the next couple of weeks before President Trump and President Xi meet in South Korea. So please read our latest notes because that will give you all of those details and everything that you need to know to navigate this unexpected burst of volatility as we move through the middle of October and through Q4. But let's take a quick look at the charts and we'll see a bit more detail what's going on. Now, obviously, starting at my favorite, this is world equity markets. Now, if you follow my pointer, you'll see European markets are sliding to the downside today. So we've got a 1% loss for the DAX and 8.86% loss for the CAC. Now, the CAC was higher earlier today, but there's really nothing stopping the sell-off in the CAC, especially with the flare-up once again in political tensions over there. And then the overall Euro Stoxx is down 0.8%. The FTSE 100, it is also lower, but it is outperforming its European peers. It is only down just over 0.25%, and that's because of its gold miners. They really are. They're propping up the index. They have done all year, and they continue to do it as the gold price made another record high today, which we will talk about shortly. But we are looking at some losses for the S&P 500. Now, this chart is the daily chart for the past year of the S&P 500. And as you can see here, that big drop lower on Friday in the S&P 500. But what I really want you to notice is this pink line. If you follow my pointer, you should be able to see it. Crucially on Friday, so after that sharp sell-off, we managed to stay above the 50-day moving average. Now that is 50-day moving average. If you don't know anything about it, all you need to remember is that once you're above that line, you've got strong upward positive momentum. When you're below that line, that short-term positive momentum really has gone. So staying above that critical level, and the S&P 500's 50-day moving average comes in at 6538, currently trading 6654. So we're not much above it. But if we stay above that level, then that suggests that momentum remains to the upside and that this risk rally can continue. But if we do break below that level in the coming days, maybe because of more of flare up and more trade tensions, maybe a disappointing earnings season, if we break below that 6538 level, that's going to make it really, really hard for that rally to continue. So that just adds another barrier to stock market gains. And remember, there's a lot of concern in markets about markets getting too frothy, stretched AI valuations. We would say that on Friday, the downside was really led by those tech companies, by those AI companies, particularly the semiconductor firms. They were the weakest performers, down some 7% for AMD, about a 5% loss for Nvidia as well. Now, as we wait for the US markets to open on Tuesday, we are seeing further declines in Nvidia, for example. That's down about 1.8%. It had rallied and clawed back some of those losses. But even as you can see with the overall index, we hadn't managed to climb back above Thursday's high. So we really have kind of resettled at a lower level. Let's take a quick look at the VIX index as well, because this is Wall Street's fear gauge. Now, the VIX index jumped above 20, so it went to 21, so the highest level since early summer. It managed to come back a little bit from that on Monday, but it has since moved higher. Now, we are above the moving averages for the VIX. To be honest, they don't really mean much because the VIX hasn't it kind of goes through long periods of trading sideways. But it does suggest that we're just in a bit of more volatile market, and there's a bit more risk aversion creeping into financial markets, and volatility is not resetting back at those low levels that we've been used to. So we seem to have made a step up in volatility. So it could be a bit of a wilder ride, particularly as we wait for that meeting between President Xi and President Trump at the end of this month. So that is definitely something to point out. Now, just on that 50-day moving average piece, I also want to show you Nvidia. Nvidia is obviously, one of the world's most highly valued companies. So it was also sold off very sharply on Friday, but it also managed to stay above that 50-day moving average. Now, I think if Nvidia was to fall below that level comes in at 179.40 for Nvidia. If we fall below that 179.40 level, that again could really weigh heavily on the S&P 500 more generally, because it's just such an important part of the index. When you've got trillion-dollar companies falling below their 50-day moving averages, that doesn't spell great news for the overall index. And that would very much suggest that uptrend that we've seen has been disrupted in the short term. Now, we've also got gold and silver. So gold and silver, I mean, look at this parabolic rise. It's another week, another day, and we're talking about record highs in the gold price. We did reach a high of 4,179 on Tuesday. That's since retreated, dropped about $40 to 4,135, but very comfortably above 4,100, which we hadn't even reached that level this time last week. So we quickly sliced through the 4,000 level. That's looking like good support. But as you can see, we've seen the rise and the run up in the gold price has been so much stronger than what it's been in stocks, that we're well above the 50-day moving average here. So we really don't see a fall at the moment back there anytime soon. In fact, if anything, as there's more volatility in markets, as there's more concern about tariffs, we're seeing the debasement trade, if you like, just rally even further. So we're seeing the dollar sell off, stocks become a bit more volatile, and that's just leading to more flows and more gains for the gold price. But not just the gold price, of course, the silver price as well. That shot up to a record high both today, to a high of 53.54, but we have since come back quite a bit. So it does suggest that there is a limit to the upside, certainly in the short time, for both gold and silver. Now, I do want to show you as well just the energy sector more broadly. So as you can see, we've got these fears about we've got more fears, obviously, about trade tariffs, what that's going to do for global growth, hence why we are lower, quite sharply lower on the day for oil, for the energy commodities, but also for some of the metals. So some of those industrial metals. Look at iron ore, for example, is down 1.3%. But look at what crude is doing. WTI crude, so that's US crude, down 2.2%. Brent crude, that's down 2%. So Brent crude currently trading, actually hovering around that $62 a barrel level, had been above 63 earlier on Tuesday morning. So we really have seen a sharp drop lower in the commodity space. We saw that on Friday, and it's just continuing. So it does seem like there's becoming a little bit of a focus on maybe the path of least resistance is lower, and it's getting a bit harder to push things higher. So that could be the sign of just something to watch out for there. And I would point out, just to reiterate yet again, we've got higher levels of volatility. Volatility is not resetting at those low levels that we've been used to over the last few months. So that, we've seen a spike higher now. We're back above 20 in the volatility space. That's not good news for risky assets. And, we are saying that it's part of the reason that for the decline is froth in the market, but also these concerns between the US and China. That's leading to global growth fears. So we are watching that. But on the other side of things, we have got earnings season that kicked off last week. We've had a strong earnings season, but it's very, very early days yet. But we have got US banks reporting this week. So they will essentially be like a proxy for US economic data. So be watching them very, very closely. Now, a lot of good news is already priced in. What I would show you here, this chart shows you the S&P 500, which is the orange line in this chart, and the S&P 500 banking index. That's the white line in this chart. They've been normalized to show how they moved together over the past year. As you can see, the gap has widened extremely over since May. And we've seen banks really outperform. These are the biggest US banks, not the regional banks. They've still been under a bit of pressure, but those big banks have done incredibly well. So there's a lot of good news already priced in. So they've really got to knock the socks off investors with their earnings season if we're going to see further gains. But it's all about their forward guidance as well. So the bar to further stock price rises for the big banks is actually quite high. So that's something to watch out for as well this week. And then I would also like to show you, these are earnings expectations for Q2, well, we've obviously been there, but also for Q3 and Q4, they've come down a little bit. So that may mean that there's a little bit more margin for error in those earnings reports. We have seen analysts just scale back just a tiny bit, and that's obviously adding to some of the downside pressure on stocks as well, because there's a bit of nervousness now as we come into earnings season. Now, the chart I'm showing you here is the last one. It is the pound. It is in a bad spot on Tuesday morning. We got some very soft labor market data. We saw the unemployment rate tick up. We also saw some weakness in retail sales. So there's a bit of concern there that the UK economy needs a bit of help. The pound has really taken the brunt of that selling. So it's coming down and it's being driven lower by the decline in bond yields. UK 10-year bond yields are down 7 basis points. Remember, yields move inversely to prices when it comes to bonds. So we've got bond prices going up today, and the UK is outperforming the rest of the European bond market space and US bond market space as well. So their yields are falling at the fastest pace. So down 7 basis points for the 10-year. Currently trading, the yield is currently around 4.58%. So we've really come down from there. And then that's very much what's weighing on the pound. So the bond market is saying the UK economy needs some help, but will the Bank of England actually provide that help? We'll have to wait and see till their meeting next week. But thank you so much for joining, guys, and we appreciate it.